Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Last week we saw quite the volatile move in the markets, and early in the week the CME elected to increase the margin requirements on both corn and soybean. The moves that we saw in corn this past week were very much in concert with the levels that we had discussed last week. We saw a very big explosion up to resistance at about 406 that halted the market. It tagged up against our volatility band here, and then we saw the market quickly decline from that threshold or from that point. As we look at it right now, we understand that corn and wheat are the weaker of the markets, and soybean perhaps has the potential for a little bit more upside, but generally speaking, the narrative continues to be bearish. And what we are noticing is that fund managers and speculative managers are really entering the market in strong form, and we're seeing a shift with the fund managers controlling the price action currently. Right now we have key support and resistance between 366.5 and 386. This area right here will probably see the market trade in for the balance of the week in terms of a sideways move. We continue to have hard resistance at the 406 level for the May contract. Mind you, Friday is first notice date for May contracts, so we will be rolling over to deferred contract. On this chart, we have our point of control levels. 396 currently is our standing point of control. And what you'll notice as well with regards to our natural trend line, that when the market came in and tagged up against this resistance level, that both the close and the open of the next day were very close to these levels. So even though the market gave us a tail that went through this number, the key opening and closing thresholds near this number was key resistance. This is something that we always want to be able to pay attention to, and that is how the market responds to our projected resistance and support levels. We'll also notice that the market came back in and is now really in a sideways movement over the past couple days. And so now as we enter into a potential timeline, which happens to coincide with the end of the week, we'll probably see the market here really kind of lose its momentum or some of the volatility that we've seen, really be sideways, and then perhaps come out of that momentum or come out of this time threshold either side of it, but we anticipate probably a lower high with the market coming back down. Currently prices are sitting right at about 378.5, and so one standard deviation above our point of control is at 420, which is well above the market, and we don't believe that the market really has a true chance of making it there, but the funds can push it to those levels if they so choose. Also, on the flip side, one standard deviation below the point of control is at 372, and then the next demarcation point below that is 353. So those two levels are going to be very important for us with how we watch and how we continue to see the market trend and what direction it chooses to move in. December corn is much of the same. We had key resistance at 406. Market came in, touched near that area, and you saw a violent reaction to that point of resistance. After reacting off of that point, we also see that 376 held the market, and now we're now coming into our 426 potential turn demarcation timeline. Now, plus or minus a day or two, either side of this is going to be key for us to watch, but it's interesting to see that the market made a major high, came in and dropped, and has now moved up into our potential timeline demarcation, and we're looking at a bit of weakness today. What this tells us is that we're potentially looking at the market drying up with this volatility and perhaps again moving a little bit sideways out of this movement, and then a next threshold will give us a new demarcation point for some more volatility to come in, depending on what kind of news occurs over the course of the weekend. For those of us that are tracking the point of control and 1 and 2 standard deviations either side of it, market is currently right at the point of control of 391. which is consistent with some of the slowdown that we've seen. Either side of the point of control, we're looking at 404 and 378. So those key support resistance levels now are going to be very key with where corn goes. Break below 378 for this December contract should send us down to about 364. And we believe that 364 will probably hold for quite some time. And this is the area where we'll probably see the market bounce up and down in between over the next several weeks. As you'll notice here with the soybean contract, it too did react off of key resistance, but its retracement or its decline off of resistance was not as big of a percentage drop as it was for corn. Again, highlighting for us that soybean potentially is a little bit stronger in spite of the bearish narrative that surrounds it. Understanding this then, what we're looking for with our cycles with the soybean contract is that the market will perhaps make a bit of a dip, come back in and make a marginal new high, and then we're looking for a very significant low to come in about mid to late May with one final rally that comes in and then for the market to drop. Now again, the fund managers may have something to say about a movement that can occur in this fashion, but it's going to be very important for producers on this side of the market to be alert to locking in potential profit here and applying the appropriate strategies to hedge yourselves in the event that the market does turn back over again. We've gone ahead and applied the point of control calculation across the life of this contract. And what we found was that the recent highs that we saw came in at 2 standard deviations above the point of control. Now what we understand then is that this 968 level is going to be very important. As long as this contract's able to hold above 968 over the next couple weeks, it's probably going to be a little bit stronger. But if we were to break 968, we would not be surprised to see a little bit of continued weakness as the market approaches coming off the board, and that follow-through would come into the deferred contract. Last week, we shared with you how we anticipated that the market would repeat what it does going into this continuation pattern on the other side. And in essence, that's exactly what occurred. The market came up into our 90-degree threshold, tagged that 1021 half number and just passed it a little bit and then completely collapsed from that point. And we are now trading in a sideways range inside of our key support resistance levels of 990 and 1021. Breaking either side of these with conviction is probably going to lead to a little bit of follow through. Again, we want to watch these key levels here and continue to have them on our radar with the price action. The point of control calculation for the November beans contract indicates that 1063 is perhaps going to be the line in the sand for this contract, and that there is a reasonable probability that prices will not get much higher than that 1063 number before coming off the board. What that means for us then is that we have key resistance overhead, and this is going to be a very important level for us to watch in the event that the market is in fact able to come in, make a higher or a lower low, and then drop back down, or if it in fact comes in and retests this area over the course of the summer and then collapse. But again, we do believe that this is going to be a very key line in the sand for the November beans contract. Additionally, what we can notice here is that our point of control sits at 960 and the 1 standard deviation above is at 1025. That 1025 coincidentally is very close to where we saw near-term resistance, and we have downside support coming in just below at that 960 number that we just spoke about. So again, we want to continue to watch and see how the market operates between these zones. Conviction on either side of these is going to be important to watch. The move in the July wheat contract was truly something of beauty. The market came in, was overbought. The stochastic crossed over there in conjunction with our natural geometric resistance level. As well, we had key resistance above here where volatility-based resistance lived. The market came in, made a very strong rally there. We talked last week about a potential time factor occurring at the end of this actual geometric circle. Upon approaching this area, the market did collapse in a violent fashion, and we saw a very nice decline from there. Currently, the market's moving sideways, but this is to be expected. Remember, we had very good resistance along this area here, and the market has now come back up to that area, and it continues to be strong resistance for him at 487. If the market's able to get back above 487, then he could potentially trade sideways to slightly up, but in all likelihood, especially if we can see a break of 468, we believe that prices are in all likelihood headed down. Here we find our natural angle coming in, which came in as very nice resistance for this contract. In addition to that angle coming in, we see that the market now is trading sideways near the point of control. Point of control is at 482.5. Current prices are right at about 482 or so. So again, the market is really going to see an important area here that it needs to decide what it wants to do. We saw in the past that this very same area caused some congestion. It's been both support and resistance in the past, but a clear break of previous lows should again send prices at a minimum down to about 450. In closing, we're particularly excited about how the crude oil contract has been moving in concert with what we were looking for. We went ahead and highlighted for us this Elliott wave pattern where we saw the 5 waves come in. We got very good support coming in near our volatility band. After hitting that volatility band, we saw the advance up in our wave 5, and now we have a very key top coming in with an important timeline. Today's market actually made a marginal new high, but he has given up much of its gain, and we have key resistance at 44.25. Now, last week, the workup that we did was on the May contract. That contract has come off the board, and the current front month contract is the June contract that we're looking at. We have this very important timeline, which is this Friday, where we're looking for a potential pivot in the market. This is an area or zone where we believe that the market can often find a change in trend. So as we approach this timeline, if the market continues to move up into this zone, it coincides with several areas of resistance. We have volatility-based resistance here. We also have our geometric circle coming in. We have a timeline coming in and previously forecasted resistance. If the market finds weakness here, we anticipate that the market should go down and again retest that 37.5 number, which would be a very nice short trade to come in inside this area here. If that occurs, we're looking essentially for an ABC correction at a minimum. That comes down to test that 37.5 number, and it could continue lower, or it could actually come out of this zone and turn back up again. That remains to be seen, but at the very least, this current resistance area that coincides with time is going to be an important time factor to keep on our minds. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.